Good morning, everyone. Jay Del Rio, helping companies do business in Latin America, appreciates your participation and welcomes you in the webinar, Reportable Schemes in Mexico and Other Topics to Keep in Mind for the year-end closing. It is my pleasure to introduce the three speakers of today. We have Leonardo Gámez, Tax Director and Head of the Monterrey office. We have Arnoldo Rodriguez, Tax Director, and Maria Jose Gonzalez, Head of the Transfer Pricing Area in Jay Del Rio. This webinar will last 50 minutes, and then we will also have 10 minutes for Q&A sessions. So we invite you to send us all of your questions using the chat during this transmission of this webinar. So I give the microphone to the speakers so they can start talking about the topic of this webinar. Enjoy.
First of all, thank you very much for having the time of joining us this occasion to discuss a little bit about very important topics now that year-end is about to close. I still remember when everyone was so excited because we have already accomplished to conclude successfully and close successfully year 2019. Time flies, and literally we are around the corner in the close of 2020. It is now November, and therefore we still need to review, or we need to start reviewing very important topics to keep in mind to have a successfully closing of year of 2020. So, or with that in mind, it is the case that we have prepared this session for you to discuss relevant topics that it is important to have on the loop so we can conclude as well successfully year 2020. So what will be the agenda or the topics that we will be discussing for today? The first one would be related to a new obligation applicable in 2020 related to reportable schemes in Mexico. I'm pretty sure most of you have heard about this new obligation. However, there are a few scenarios, there are a lot of compliance that behind this obligation, and our experts will make sure to cover all of them, or at least the highlights of each one of them. The other topic that we will be discussing as well will be related another obligation or another mandatory assumption in the income tax law for 2020, which is related to non-deductible payments that Mexican residents made to its related parties when they are located in preferential tax regimes. If that is the case, the payments that Mexico is making could be considered non-deductible if certain requirements are not met. The other topic that we will be reviewing as well will be related to materiality in the tax reviewings. What we have been saying so far in the last couple of months related to materiality for the tax reviewings, and what advices and best practices we can recommend you to keep in mind to avoid being subject to rejection of your deductions. Another topic to keep in mind as well will be definitely the interest topic. As you know, there are some rules in Mexico applicable to interest that could limit its deductions. Two main rules, the first one, thin cap, and the second one, the net interest rules. Our experts will be explaining a little bit about these ones and things to keep in mind in order to avoid a non-deductibility expense related to interest. The other hot topic in Mexico definitely is the outsourcing. What's to come? What we have been seeing from the government in the last couple of months, and what is to be expected in 2021. Definitely a very important topic. And finally, but not least important, COVID-19 and its effects on transfer pricing operations. Definitely our experts from the transfer pricing area will have a lot of relevant information to share with you. We definitely recommend you to keep in here to review this topic as well. We will make a quick summary of all of the topics that we have reviewed and a Q&A session just like my colleague Alejandra already explained. So going directly into the first topic of today, we have the reportable schemes, which is the new obligation in 2020. And for this, my colleague Maria Jose will make sure to give a little bit of background.
Thank you, Leo. Yeah, well, I'm just going to start with the background. I think we all know a little bit of this. We all have heard about, I think we all have heard about the 15 actions that the OECD in a project called BEPS already launched. This all started in 2012, 2013 when the G20 countries asked like for guidance. They were seeing that there was been base erosions and shifting of profit related to tax plannings and other issues. So they asked for the OECD to issue some guidance and some limitations of this. Specifically here, we are going to talk about the Action 12. The reportable schemes that we are going to talk about right now, or Arnoldo and Leo are going to talk about, actually is not new for some of you probably, because you have read about it. It is reportable schemes, it is Action 12. And what practically is saying is that requires that taxpayers reveal their aggressive tax planning mechanisms. Probably not that aggressive, but definitely all tax planning mechanisms you have to reportable in these schemes. Next slide, please. The final report of Action 12 of BEPS has already launched. This will give definitely to tax authorities transparency, but they are going to have a timely information. That is something important, and that is something that definitely the OECD and the tax authorities were looking for it. But to talk about specifically for Mexico, what is reportable schemes here in Mexico, Arnoldo is gonna lead us to this.
Thank you very much, Maria Jose, for those comments and that background that you shared with us. I think that is very important to keep in mind in order to foresee what's coming for Mexico, right? And as you mentioned before, the intention of these reportable schemes is basically letting know the tax authorities what are the aggressive postures that the taxpayers are taking care of, right? Or they are implemented. So in order to have this, they must be two subjects involved in this, a taxpayer and a tax advisor. For taxpayer, basically what we can understand from that is that the person who implements it, or the ones that have the benefit of that scheme, right? And for tax advisors, we can understand that is a person or a legal entity that implements it, carries it, administrates, or commercializes it. So in the involvement of those two subjects, we can understand that they may be a reportable scheme in case there's a tax benefit that is being obtained in Mexico, regardless the tax residence of the entities. And well, what we can understand from scheme? Well, basically any scheme can be understood as any plan or project that is commercialized between the subjects that we mentioned, in which it can be from an express or tacit manner, in which it tells the taxpayers through a series of legal acts to carry something, right? For express, we can understand that it can be a legal document that states it, and from tacit, well, as it mentions, it is not expressed, but it can be understood. So that's what a scheme really is. And in order to see what the tax authority is looking for and what makes a scheme reportable, well, basically what makes a scheme reportable is that there's a tax benefit that is being obtained by the taxpayer regarding the scheme mentioned before. And for tax benefit, we can understand that is any effect that a contribution has, specifically in the elimination, deferral of the tax. So if those elements are being subject to this operation, the taxpayer, tax advisor, tax benefit, and some express or tacit communication between each other, it can be considered as a reportable scheme. It is important to mention that the federal tax code as of today already establishes around 15, 16 reportable schemes that the tax authority has already knowledge, or they want to know which payer and tax advisors have been dealing with, right?
I would just jump in, Arnoldo, just to expand a little bit on the part of the tax benefit. Unfortunately, the law or the federal tax code does not specify if what tax benefit it's only related to income tax. Some advisors may think it is that way. However, from our point of view, the tax benefit, it's very wide open, and it does not only triggers income tax, but it could trigger as well indirect taxes such as VAT, special taxes in Mexico. So in general terms, we would define that tax benefit comprehends all types of taxes that falls into this assumption of a reduction, elimination, or temporary deferral of any contribution itself, whether if it is income tax, VAT, withholdings, etc.
That's very true, Leonardo. Thank you for the contribution, and it is very well explained that it is not only for direct taxes, it can be also for any kind of contribution, as you mentioned. Thanks. Moving on to the following slide. Well, as I mentioned before, the tax authorities has already knowledge or is already looking for around 15 reportable schemes that they have detected in the past. So we can summarize them and talk a little bit more about them. So we can start with the first one, which is avoiding the exchange of information between foreign tax authorities with the Mexican authorities. The second one is avoiding the preferential tax regime rules here in Mexico. The third one is to transfer tax losses between companies that carries a series of legal acts between them in order to transfer them between one and another. Thank you. And the fourth one is that a series of interconnected payments between legal entities or persons are being carried from one to another in order for the shareholders or the partners to receive such resources as a whole or partially. And the fifth one is the payment made to a foreigner in which that income is treated specifically under one procedure here in Mexico, but under the tax jurisdiction in the other country may be treated differently, even though it has a double tax treaty that is being applied.
So the sixth fraction out of 15 that the government is pursuing to report, or that the advisors report on their reportable schemes, would be whenever there is a restructuring of operation that comprehends, first one, transfer of intangibles. Whenever there is a restructuring and a transfer of intangibles is in place, it needs to be reported. Another scenario would be whenever there is a restructuring operation that takes place and they reduce their operating income by more than 20%. That would be another assumption that would need to be reported as well to the government. Another one related to restructurings of operations would be whenever there is a transfer or concession of goods without any cash disbursement or without any monetary participation involved in it. So anything related to free of charge would be something that would need to be reported. The other one would be the scenario when there are no reliable comparatives for transfer pricing purposes. This would be the case when you have a very unique or very atypical operation that it is very hard to find a reasonable comparative in the market, so you can compare and determine that it is within arm's length principle. That would be another assumption that you would need to report. Another one would be whenever there is a unilateral protection regime that it's used for transfer pricing guidelines as well. Those 5 topics would fall into the same category of restructuring. So bullet number 7 or scheme number 7 that needs to be reported, it's related to whenever taxpayers avoids constituting a PE in Mexico. And this is a very thin line for the advisors, because sometimes we have clients that they plan to set a business in a different country, for example, in Mexico, and they look to avoid the PE. Okay, if we provide guidance on that matter, we may fall in this category, and therefore we would be forced to report that we have advised a taxpayer to avoid a PE. So it is, again, a very thin line, because one thing would be that the taxpayer asks you questions, specific questions for yes or no, and you're only speaking the truth, like very straightforward. But another different scenario is that we provide advice on the route to follow to avoid a PE. So if that is the assumption, we definitely need to inform it. The other scenario would be the transmission of a depreciated asset, which allows another entity its depreciation. So in a certain way, we revive the depreciation so another entity can reuse it again. Another scenario for reporting schemes would be hybrid mechanisms. Hybrid mechanisms, as you may know, is when there is no symmetry in a certain operation. So a payment that is done from Mexico to X country. In Mexico, it's a payment, and in the other country, instead of being a revenue, it comes as a payment as well, or an exemption or something different. So there is no symmetry. Whenever there is a hybrid mechanism involved, we would need to report it as well. The other scenario would be the one where the beneficial owner of the income or asset is avoided. If we set up a certain type of structures or tax planning in order to avoid that the beneficial owner is known, we would need to report it as well. So item number 11 would be related to tax losses. As you know, tax losses in Mexico expires in a 10-year period. However, if we know that our losses are about to expire and we prepare a tax planning in order to trigger profits to be able to amortize those losses and in order to avoid expiring, then those actions would be considered a reportable scheme that we will need to report to the government. Another scenario, as you know, since 2014 and for the subsequent years, there is a 10% withholding for dividends that Mexican companies do to foreign residents. So if there is a scheme implemented or tax planning implemented where this 10% of income tax withholding paid on dividends, it's avoided, then we would need to report it as well. The other scenario would be the use of an asset that is granted in the lease and in turn grants the use of the same asset to the leaser. So kind of like a back-to-back, that type of operation would be something as well that would need to be reported. Item 14 out of 15, it would be that involves operations whose accounting and tax record presents differences greater than 20%, except related for depreciation. If that is the case, it needs to be reported. And item 15, like the government likes to do it, pretty much covers everything, that it's not complemented or it's not comprehended in items 1 to 14. Whatever we're missing, included in the item 15. So with that being said, what is the information that we need to report? My colleague Arnoldo will explain this part.
Thank you, Leonardo. Well, that was very well explained. Thank you very much for that. And in order to see what's coming, in case you are subject or some of the disposition that Leonardo shared before, the federal tax code states general rules at this moment, right? In which these reportable schemes must contain at least the name of the company, tax ID, name of the legal representatives, what is the reportable scheme, relevant information, what is the tax benefit that it is intended to obtain, and if it is a reportable scheme already identified from from the 1 to 14 fractions of reportable scheme, there will be an identification number that must be stated in that return. If not, as Leonardo said, there's that 15 reportable scheme in case any tax benefit is obtained from any kind of advice from a tax advisor. There will be special rules. It is important to mention that as of today, tax authorities has not published yet the special rules in order to file this return. So we will need to be very aware and very and pay attention to what the tax authority states in the following months in order to see what are the rules in order to file this return.
And I guess in terms of the information to file, Arnoldo, Ali, can you go back to the prior slide, please? In related to the information to file, I guess it's the one that it's already here. However, the how to file it, it's still in question mark. It's the part where the government is pending to issue the official form that in which they will request you to fill in and prepare and send all of this information. So definitely it will be worth to mention that this is the information to start gathering. However, as Arnoldo was mentioning, we will need to be aware of when the government publishes this official form. So after that, we can file this information.
Totally agree on that. And it is important to mention that as the federal tax code states as of today, the first obligation or the obligation goes for the tax advisor who shares that reportable schemes, right? But it also states two exceptions to that rule. The first one is when there are foreign entities that are having a tax benefit in Mexico. So in that case, the obligation of filing it is for the taxpayer. And the second one is that when the taxpayer implemented it or administered it before fiscal year 2020, but is obtaining a tax benefit in 2020. In that sense, that obligation is also applied for the taxpayer. Moving on to the next slide. Well, for general rules, in case for the tax advisors must file this return, the obligation is due 30 days within the first contact of commercialization of the reportable scheme. It doesn't matter if it's a document that it was shared at some point in time. Well, it can go back even though to meetings. It can go to that sense, to the meeting that it was shared the idea. In that moment, that due date starts running for the 30 days limit, right? So for commercialized and for reportable schemes, we can understand commercialized, organized, implemented, managed, designed. So it is a very open definition when this 30-day due line starts. And of course, as mentioned before, we need to be aware of if there is a reportable scheme that was implemented prior fiscal years of 2020, because that reportable scheme, if there's a tax benefit in 2020, must be filed in. Moving on to the next slide, we can find penalties and fines. I think it is a very important thing to mention here because there are fines that goes from 25,000 pesos and can go up to 20 million pesos. So there's a very high range. Of course, there's a specific infraction if you carry in order to be subject to that 20 million pesos. But basically the infractions are very common, in which a reportable scheme is not filed or it was incomplete filed, having a purpose of not filing it complete, not filing in time, not filing it with the complete information, or if it was modified during the time. So those last infractions carry a more lower sanctions, but I think the one that we need to be taking very care of, or we need to take care of, is the first one that can go up to 20 million pesos, which is not filing a reportable scheme, and if so, filing it correctly. So it is very important to have that in mind. in order to wrap up this very important matter that we wanted to share with you today, here are some recommendations that we want to share with you. Well, basically is to identify if we have a reportable scheme or the company or the taxpayer is applying a reportable scheme, to have in mind. The second one is to know the structure about the scheme, if it's being applied, in order to detail it correctly and not be subject to a fine or an infraction, of course. And the compliance states, of course, that depending of the commercialization or the meetings that we just mentioned before are very important to state in that. And it is also a very important task for the company to analyze what are the activities or the operations that were carried before fiscal year 2020 in order to foresee and see if there was implemented a reportable scheme before. And of course, the rules that the tax authority must publish in the following months in order to see if there's a specific information or a detailed information that must be filed in this return. So in that sense, I would like to invite my colleague Maria Jose to share with us a little bit of her comments and knowledge about these non-deductible payments regarding preferential tax regimes.
Thank you, Arnoldo. Well, also this year in 2020, we also have the non-deductible payments to related parties abroad in preferential tax regimes. I mean, in Mexico, the preferential tax regimes, probably you all think in the typical countries that we all know as the Kevins and we have in mind, but you have to know that in Mexico, all the countries or states that its corporate effective tax rate is below the 22.5 falls into this category. So probably a US state or entity that is in the US or another country and that you might not think that falls into this category of preferential tax regime actually falls in it. In Article 28, it was added to Section 23. What it establishes itself is that payments that taxpayers make directly or through structured agreements to preferential tax regimes are non-deductible. Obviously, the article and this section puts there exceptions for it. Specifically, they say like you can have an exception and you can deduct if the recipient of the payment, the entity that receives the income in the preferential tax regimes, actually has a broad information exchange treaty with Mexico. So that is one condition. And the other one is that the income or the entity that receives the income actually that income derives from a business activity. The entity has to be able to prove that has personnel to provide the services or whatever is the business activity. They have the assets, they have all the functions related to the activities and they are able to provide. And also that the payment is indirectly taxed for the recipient. So what are the non-deduction assumptions? Well, the first one I already mentioned, it is pretty simple. Payments to related parties that resides abroad and are in a preferential tax regime. The second one are the payments that are to related parties. Probably they actually are not in a preferential tax regime, but they in turn make payments that for them are deductible to preferential tax regime, to entities in a preferential tax regime and that are related parties. So the deduction for the Mexican entity in this structure is also non-deductible. And the third one is what we call the hybrid mechanisms, when payments to related parties that reside abroad in a preferential tax regime or a FIPRE country, and that payment is characterized differently in Mexico and then in that country. So part or all of the payment is not taxed abroad. That is also a condition for non-deduction. So what do we do? What do we recommend? Well, actually, what you need is first identify if your entity, if your intercompany transactions falls into this, if you are under a payment in a preferential tax regime, and once you identify, find yourself support. We highly recommend for you have a defense file for this. Obviously, we can help you with that. But basically, what you need is to prove that the other entity, the entity that receives the income, actually is having a business activity. How to prove it? Well, you need to demonstrate functions. You need to demonstrate personal assets, the different departments that it's going to have. Having documental support, physical and digital, not only the invoices, but also purchase orders, service orders, questionnaires, whatever you need. And last but not least, review your intercompany contracts. Probably there's something that, in the light of this article, I mean, so you can see it. If there is something that do not has a conflict or creates a conflict for you for your payments in this kind of assumption. So now we are going with Leo with the next, what happens at the end of the year.
Perfect. Thank you, Maria, for that nice explanation about this topic. So the other topic that we briefly want to explain you, or we want to give you our feedback of what we have been seeing from the tax authorities reviewing, it's related to materiality. As you know, next slide, please. As you know, the tax authority has the ability to request certain information from taxpayers to validate from their point of view that the operation really took place and allows you to take the deduction or to credit your VAT at any point. So nowadays, what we have been seeing during the past couple of 6 months, I would say, and going forward, it seems to be the trend. It seems that the government is looking for more information besides the regular information we were used to provide, which we were used to provide invoices, agreements, and that was it. But nowadays, it seems that the authority is looking for something beyond. They're looking to have a materiality, a substance of your operations. And this is relevant to point out that it's related to both of them. So it relates to revenues, but also to your expenses. In this case, the most relevant topic for you, of course, would be the ones related to your expenses, because those could be the one that in a very extreme position, in a very extreme situation where the government audits you and claims that there is no materiality behind your operation, then your payments could be considered as non-deductible. Or the VAT that you pay to X supplier, it is non-creditable. And worst case scenario would be the one where the government claims that you do not have materiality. So from their point of view, there is no substance behind your deduction or what you plan to deduct. And therefore, they could claim that you are acting or having operations that you're having, non-existent operations. That means that automatically could send you to the blacklist of the government. As you know, the government has a blacklist of fraudulent taxpayers, we could call it that way, taxpayers that from their point of view deduct on unexistent operations or issue invoices for unexistent operations. So if you fall in this category of not being able to prove the materiality of your or substance of your operations, you could be subject to it. So next slide, please. As we will be seeing in this slide, materiality pretty much comprehends all the information that support that a good was effectively delivered or a service was effectively rendered. Most of the times we used to remember, or we used to think that the invoice was strong enough to support X type of deduction. However, the trend seems to be that the government is looking for more. Can we go to next slide, please? What are we recommending our clients in terms of materiality? As general rule, mandatory rule, definitely to have your electronic invoice, have an agreement executed and ratified with a notary public. A lot of times we see agreements that are not executed, and by executed I mean those are never signed. It's a draft agreement, but it was never signed by the parties involved, whether if it's a non-related party or a related party. Definitely to have it with a notary public, because for Mexican purposes, unfortunately, the Mexican tax authorities sometimes claim that you just prepared the agreement at the moment of the audit. So the fact of you having it notarized supports that the date of it was not today. You did not draft it today, but you drafted when the operation took place since inception. So that's pretty much the reason behind the recommendation of have your agreements notarized. Another recommendation as well is to implement a selection method of suppliers. The government are starting to look in the reviewing and are starting to ask, okay, you picked this supplier. Tell me, why did you pick him? Show me your 3 main quotations of the other suppliers that you requested, which lead you to at the end pick this one. So that's why we are suggesting from now on to have a selection method of customers. As well, be able to demonstrate that the person who approves the purchasing processes, it's someone that works within your company, from your purchase department or whatever. And then we have 2 types of baskets. We have sales of product basket, which have certain recommendations as well related to have an inventory control, the procedures of the addresses of where the goods are located, etc. And for the intangible assets, so everything related to services, make sure that the personnel who intervene in the process, you have time and hours logs, the addresses in which the work was carried out, etc., to try to support as best as possible your operation. If we could move forward, please. These are finally high topics or high level recommendations that we're making to our clients. At all times, definitely have a defense file. Be able to go more than the obvious and to have as much support documentation as possible to demonstrate the materiality of operations, particularly at all times related to intangible assets. Everything that could not be touched, measured, or seen, like a service, for example, etc. Those are the ones where the government is really paying a lot more attention. So at the ending goal should be that you are able to prove that the operation effectively took place. That's literally your ending goal. And for this are the recommendations that we're making to all of our clients. So the next topic that we have in our agenda is related to interests. And for this, my colleague Arnoldo will explain.
Thank you very much, Leonardo. Well, as you may have heard, there is a new limitation of interest that was introduced during this fiscal year, which is basically a net interest deduction procedure that it was incorporated. If we can move to the next slide, please. And we already have a capitalization rule, which is very common across the world, which basically states the ratio of debt against capital, right? But just getting first to the first and newest interest deduction rule, basically what it intends to do is limit the deduction of the company according to the net tax profit of the company, right? So the tax authority doesn't want to see a very small company with a very low net tax profit with a lot of chargeable interest or interest making deduction. So there's a limit that they introduce around 20 million pesos of net interest, in which case if it's lower the net interest, this rule will not apply. But if it's over, you need the taxpayers must do the procedure, right? So moving on to the next slide, also this rule applies for any kind of debt, any kind of interest. It doesn't matter if it's with related parties or not, but also there's a new ingredient to this rule, which is that it is not only applicable per company. So this procedure must be taken in consideration as a whole group. In case there is a group and there are related parties in Mexico in which there are operations with each other, that limit of 20 million pesos or threshold of 20 million pesos of net interest must be proportionally divided according to the companies regarding the cumulative income of each company regarding the previous fiscal years, right? But also, this specific rule led the taxpayers to carry forward 10 years the non-deductible interest that are being made during the fiscal year, to carry forward 10 years in order to make them deductible, of course, under the procedure established in the income tax law. And exchange rates and exchange gains and exchange losses are not applicable to this procedure. There are some exemptions that must be taken in consideration in order to carry this procedure. Moving to the next slide, and well, the thing capitalization is very basic compared to another countries, specifically to the ones in Europe, in which the ratio that establishes the income tax law is 3-to-1 ratio between free debt from related parties residing abroad, specifically to 1 to capital, right? And in case the newest rule is applicable or has a non-deductible which is higher than the thin capitalization rule, we will only consider that non-deductible from the newest rule. And these calculations are made annually in the annual tax return that must be filed during March, the last day of March of the following year, right? And there are some interest and provisions that must not be taken in consideration as of debt or interest that are specifically regarding some incentives or some areas that Mexico government has been exploring too, such as energy resources. Such debt must not be considered. And also financial companies from the financial system that are considered here in Mexico, such will not be applicable. Such procedures will not be applicable as well to them. So if we can go from the next slide, I think Leonardo can share a little bit of comments regarding what's happening here in Mexico with the outsourcing scheme.
Sure, thank you, Arnoldo. Yeah, so this is definitely a hot topic in Mexico, particularly today. Actually, we just received some news from the government, the president of Mexico today in the morning issued his initiative for restructuring the outsourcing rules in Mexico. So what's to come here for the outsourcing in 2021 or literally in the near future? As you know, the current structure of the outsourcing works where there is an operative company that usually or most of the time does not have any directly employees hired. And in the other hand, there is a service company, whether if it's an outsourcing, which is most of the time non-related parties, or insourcing, which most of the time it's related parties. At the end of the day, this service company holds the employees and has them directly on their payroll. And there is a service agreement between them both where the service company agrees to provide the employees to the operative company for his business operation. So this way, the payroll liabilities are held at all times in the service company. Of course, for the operative company, there are certain benefits of having a type of structure like this. For example, contracting company does not have labor obligations as well. The ease of replacing employees, it's way easier to replace staff in these type of structures. Limits as well the risk in case of strikes, because most of the time the assets remains in the operative company where you do not have employees in there that could look for in case of strikes, and among other benefits and situations. So again, what is the trend that we're seeing for Mexico? Ali, can we go to next slide, please? So the trend that we're watching in Mexico, it's The president itself has stated clearly in the newspaper and on the medias that part of their projects, that part of their objectives in the near future is the elimination of the outsourcing scheme. From their point of view, the government claims that unfortunately some fraudulent taxpayers, some fraudulent services companies have abused of the outsourcing schemes in terms of they charge VAT for their service, they collect it, and they do not pay it. So they keep the VAT. That is one undue practice that the government wants to eradicate by eliminating the outsourcing scheme. And the second one is related to the Social Security contributions. Those are the two main objectives of eliminating, from the government to eliminate the outsourcing scheme. At the end of the day, from the government's point of view, the companies should hold the employees in their payroll directly. Of course, there is some other economic impacts that the elimination of the outsourcing could cause in Mexico. So we feel it's very aggressive in making a statement like that in terms of from this moment going forward, outsourcing will be eliminated. Of course, there could have a lot of impacts in the economy of Mexico. However, we will definitely see a trend in 2020 and 2021 related to audits and requirements from the government from labor matters. So what can we expect? Definitely the government will make sure that you're in compliance with labor laws, particularly our Article 15A, which talks a little bit about labor law requirements. So if you do not make sure that you are meeting these requirements, then the operative company could be subject to non-deductible expenses to all the payments that are made to the outsourcing company. Then the non-creditable of VAT to all the payments related to the outsourcing company, and exposure in the operative company of having to distribute from its own profit the 10% related to the profit sharing. Those could be the potential exposures for the operative company that does not make sure that the services company is meeting the requirements for the federal labor law. As well, what the government will be looking to pursue is that the services company itself has economic capacity to face the payment of its contributions. So technically that it's not only a paper company that does not hold assets, does not hold anything but literally the employee. So that will be something that we will need to look for. Does this mean that we must immediately eliminate any type of a structure where there is a service company involved? Not at this moment. We will definitely need to see the initiative that the government just published today. There is a process that needs to take for this initiative in order to be approved. It needs to go to the Senate, then it needs to go to another chamber. So there is a few changes that could come into this proposal that the government is making. So definitely we need to look for the final document to now analyze what needs to be done. At first sight, companies are starting to carry out a feasibility analysis comparing pros and cons of keeping their same insourcing structure to have their own insourcing company versus not having it and absorbing the employees in the operative company. Some clients are currently starting to carry out those analyses and determine the pros and cons of doing so. Of course, at all times, the profit sharing could be one important element to keep in mind, but as well, there are some other topics that if there is a reasonable feasible study in place, it could be analyzed and lead you to the conclusion that maybe it is not that bad to incorporate your employees to the operative company. Definitely something to keep in mind. So the next topic and final of our discussion will be related to COVID-19 and effects on transfer pricing. And for this, my colleague Maria Jose will make sure of talking about this.
Thank you, Leo. Well, I think everyone has heard about effects of transfer pricing in COVID-19 and probably not transfer pricing, but intercompany transactions, and probably your companies are living it. You already have to change something in your supply chain, in your demand, and changes between the group, within the group are happening, and these obviously are going to have impact in how you document and how you present it to tax authorities. Which are the consequences medium long term? Actually, I think we don't have a crystal ball, but we already know that there are consequences, immediate and reduction of demand. We also saw the impact of supply chain providers that could not manufacture the products, border closed, some impacts that now we are starting to account, but probably they're going to have impact either in the future. We are seeing financial markets going in a crazy time with lower rates from federal banks, but going really high in some corporate bonds, and behaving in a way that we haven't seen in many years. And obviously business, for example, here in Mexico, there are many subsidiaries that continue to hold with idle capacity, keeping their operating costs, not generating the income expected, or that gives them a benefit or a profit. Next slide. So what we recommend, well, review your transfer pricing documentation. It is important to have in mind what you have done in the past, what you will do in the future, what you're having now, and how you're going to present it to tax authorities, and how you're going to present your reality, and to check if you are acting actually as third parties will do, or you are just taking emergency sales that actually not complying with transfer pricing, or they do. It is important to mention, we all expect that comparable companies we use in the transfer pricing reports, they are going to have operating profits, but lower, they have different results than other years. But right now, we know that we have temporary effects. They publish the information around March, February, April in some cases, and we're, for example, here in Mexico, we have to present the information in March. So we definitely not going to have on time the comparable companies information, and we have to adjust this. Not forgetting that the income of companies comes from functions, risk, assets, what's happening. If there was restructure in your company, in your multinational group, or in this time, what was the restructure? Which functions did you perform? Did they change? How to consider these changes? How the margin was going to be impacted for this? You need more, you need less, you need to move to another activity or another risk level. You were a low risk entity, but right now you're going to be full-fledged, or whatever, or the other way. You thought you were a low risk entity, but and in reality, in your financial result, you're reflecting that from low risk you don't have anything. You took all the risk of the activity, and you're seeing your losses, or the Mexican subsidiary is seeing the losses. So all the things have to be reflected in the report and have to be analyzed on time. Here in Mexico, any adjustment that you perform after the year closes has to be informed to tax authorities. It is possible to do it if it is to comply with Mexican tax regulations, but you have to do it in reported to tax authorities if it is a deduction or something. And well, we also going to see, or you have to see if you apply or are going to apply force majeure clauses for your terms and conditions and your intercompany transactions, and maybe a solution for a cash problem that you may have right now in your Mexican subsidiary. I'm going to talk about specifically the two transactions, financing and royalties. Here in financing, we are seeing in the market possibility of low restructuring. I mean, we saw the banks selling to the clients, you know, you can have 4 months of not paying it, or after 4 months you can continue, because we understand, it is understanding, but it's restructuring, but because they knew you couldn't afford these payments. So in intercompany transaction, probably you're going to behave the same, or not. It depends in the industry and the region. Shorter term debts Are you going to go for long term, for short term? Right now, the market is giving more short term than long term because they don't know if you're going to be able to pay more than 5 years after. Fixed rate versus variable rate. Right now, for your intercompany transaction financing, intercompany transactions, you review your interest rate yearly basis. Right now, the rate that you established in this year probably is going to be different next year. So check it. And the country risk in Mexico is going also really high. So probably want to check those. And for royalties, well, just to keep in mind that you can do something in your royalty scheme that probably the Mexican entity does not need to pay this year, this royalty, because the intangible was not used, or you can use a tranche basis or a staggered approach where certain royalties can be done. It is expected that natural reduction of royalty is going to happen because your sales are going to be down, but also things related to royalties can be done, and obviously you need a comparable royalty rate analysis. And I think that I went fast, but I think the main ideas were there. And thank you.
Thank you, Maria Jose, for sharing that very helpful information in order to foresee what are the things that we must take care of for this fiscal year to end. And basically, just to summarize, well, thank you all for picking up with us for this time. But just to finish, we want to share with you some key points in which J.A. Del Rio may assist in we review through this time, right? So reportable schemes in Mexico, it is very important to keep in mind if we are applicable or not, depending on the situation. If you have any kind of doubt if there's a reportable scheme involved, please let us know. Regarding non-deductible payments, Maria Jose, I don't know if you can share with us.
Yeah, I think we can help you with that. Do not hesitate in contacting us to identify if your intercompany transactions are actually falling under this rule, and after that, helping you with the defense file for your for each entity to comply with Mexican tax regulations and to assure that they are in these business activities and they can fall in the exception that this rule allows.
Correct. Well, and following the third topic is the materiality of operation. Basically, is looking for the substance of each operation and getting the documents and legal agreements and all that kind of operation that Leonardo shared with us during today. So in that sense, we can assist you on making that analysis. And for the considerations of deduction of interest, as I mentioned before, it is very important to keep in mind the procedure that establishes that the income tax law establishes as of this moment, and how it may affect the entity or the group and the entities of a group according to this. And the fifth one is the outsourcing, right? And Leonardo shared with us that today the president just shared news about this topic, and in order to carry forward, there must be an analysis of the situation specifically for each company and the service company in order to fulfill the requirements that the federal labor law states, in order to see if it's applicable and it's feasible to keep doing it as it is.
Well, and last but not least, I think the COVID-19 transfer pricing, I just want to say, do not forget transfer pricing documentation. See if your intercompany transactions are actually doing okay. For this year, you're on time. It's really short in time. We are beginning of November, middle of November. But if you have to check, you want to check something before the year closes, we can help you with that. Or with your transfer pricing report, we have until March to present the results for it. Thank you.
Okay. Thank you very much for Leonardo, Maria Jose, and Arnoldo for their great contribution on this topic. Okay, and just to remind you that this webinar will be available in our YouTube channel. Okay, we have the first question. When does the reportable schemes informative return needs to be filed? Who can help me with that one?
I'll take that one, Alejandra. Thank you very much. Regarding the fulfillment of such a reportable scheme, the federal tax code states that must be filed within the 30 days of commercialization. As we shared before, it doesn't matter if it's already implemented or it is just a meeting. As soon as there's this kind of contact between the tax advisor and the taxpayer, those 30 days period start counting.
Thank you very much, Arnoldo. Okay, we have another question. Is there a list of requirements to be included on the defense file mentioned for Reportable Payments? Who can help me with that one?
I can help you with that. There is not official requirement or a list that you need to fulfill. This is a recommendation that we do to support your activities, because the idea, or the main idea, is that actually you have to have the personal, the assets, because that is mentioned in the law. So that is the idea. But there is not a specific list for it.
Okay, thank you very much, Maria Jose. Due to the time, I told you that we were only answering 2 questions, but don't worry, we will contact you as soon as possible to reply to all of the questions that you send us, okay? And well, we have reached the end of this webinar. J. Del Rio, helping companies do business in Latin America, appreciates your participation and your interest in this topic. And we invite you, if you have any other question or query regarding this topic, to send us an email to contacto@jdelrio.com. Thank you very much for your participation and have a great day. Bye-bye.
Thank you, everyone. Have a good day.
Thanks, everyone.